Chapter 37. Brokers. This book was written in an age of centralized brokers, clearinghouses, rebates, regulations, and more. I see many issues with current centralized asset markets and plan to spend a large part of my coming life decentralizing asset management to truly open the floodgates, holding back global asset growth opportunities that could build you real savings and retirements. With that said, I wrote this book to abolish the educational barrier to entry into finance for all. I want this work to stand the test of time, so please understand that some of the information presented later in this chapter especially may change in the coming decades as blockchain technologies grow in global development and utilization. However, the principles we go through here hold true and should stand at the core of your broker-dealer analysis. These institutions are your gateway into financial markets and asset growth, and they are in constant competition in a centralized asset market. Find the best option for your situation and always watch for options that are more competitive. Ready to get into the markets? Investment brokers are your access point to financial markets. These brokerages, regulated by the SEC, connect asset buyers and sellers based on marketplace orders submitted by investors. To understand how brokers hold your assets, let's explore how stock ownership works in an internet age. The oldest known stock certificate came from the Dutch East Indies Company from Holland in 1606. Stocks started on paper, and you can used to physically exchange them with your broker. Today, you no longer have to have a piece of paper to trade stocks, but you can still specifically request a company send you a paper stock certificate. You can sell your old-time paper stock certificates by signing a transfer form for the stock and notarizing it for a transfer agent or stockbroker to liquidate. Companies keep track of current bondholders and shareholders using transfer agents and registrars. Companies use these records to record changes in stock ownership, shareholders to pay dividends to, and bondholders to pay interest. For your purpose, the registrar keeps track of all outstanding shares as well as the number of shares owned by each shareholder, so there is an official record of your stock or bond ownership. We will look more at how you are identified on these ledgers soon. Bond registrars also record interest rates due so that your debtor-borrower knows exactly how much to pay you each year. Just as a stock registrar updates when someone sells shares to another investor, a bond registrar updates when someone sells their bond in the secondary market. These ledgers can be maintained by the underlying company or outsourced to a third-party trust or bank. The constantly updated list contains basic information like each shareholder's name, their address, used for mailings, annual reports, dividend checks, tax documents, and other documents. How much stock you own, stock transfers, direct deposit address, dividend addresses, if applicable, and other miscellaneous information like physical certificate history and stock class. Remember that preferred stock gets paid dividends first and may receive more voting rights than common stock. Since stock transfers are all electronic by default today, your name can be in a company's transfer agent book depending on how you purchase stock. With direct registration, you can buy stock directly from the underlying company, and management sends all mailings and dividends to your address. This form of registration is commonplace for direct stock purchase plans and employee stock purchase plans, in which you can purchase direct company shares. To avoid brokerage fees, which we will further explore soon, you can use direct purchase plans from individual companies. Fees vary depending on the corporation, but you will usually save cash thanks to the extra time commitment to buy directly from a company. Some exceptions for extreme budget brokers. See comparison table coming soon. You can also purchase fractional company shares through direct stock purchase plans as you start off if an expensive stock would unbalance your portfolio. Most direct purchase plan companies also allow you to automatically reinvest your dividends in dividend reinvestment plans that promote long-term holding, capital appreciation, dividend compounding, and overall growth. However, direct stock ownership, when available, comes with decreased liquidity and control over your investments. Rather than instantly buying or selling your shares on the market at any price you choose, you must notify the underlying company that you want to buy or sell your shares. Then, the company will purchase or sell shares for the plan along established intervals like once a week at an average market price, often VWAP, or a high-low average from the previous trading day. If you're willing to put the time and energy into opening plans with a diversified group of companies, you can use direct stock purchase programs for long-term investing to decrease transaction fees, receive direct corporate recognition, and reinvest dividends with fractional shares. You can also order physical stock certificates through these programs if you want nice, expensive wall art and do not mind a tedious and fee-filled selling process on top of physical certificate security against damage or theft. Most shareholders stick with online inventory to streamline their investments. The process for selling physical shares varies greatly depending on the underlying company or brokerage you buy them from, but it is almost always slower and more expensive than electronic fulfillment. It is much easier to simply hold all your stocks in one or two brokerage accounts where you can purchase stock, have dividends reinvested, and efficiently liquidate any position you desire at your desired price with custom order types. See Chapter 19. For non-day trading, brokerage accounts are an absolute necessity. For long-term investors, these accounts streamline your portfolio at a centralized location and give you access to companies without cheaper direct stock purchase plans or dividend reinvestment plans. You will always want a brokerage account to use their research tools, stock screeners, trading software, and access to investment options such as options, currencies, futures, and of course stocks. When you electronically send a market order to your broker, they instantaneously determine the best way to route your order based on available market prices. First, your broker looks at prices on exchange order books. Then, the broker compares quote prices to those of third-party market makers, secondary pool participants, and internalized trades. Internalization occurs when your broker fills your order from an inventory of stocks owned by the brokerage or from another buyer or seller of the same stock at the brokerage. Your broker will only internalize a trade when they can get a price at or better than the market quote. Additionally, your broker has a duty to seek the best execution path readily available for your market order. They will scan the entire market in a matter of microseconds to help determine the best order route according to their algorithms. Most brokers initially try routing orders internally or through market makers and secondary pools to avoid marginal exchange fees while still filling your market rates. The market maker is simply a firm that buys or sells stock along a bid-ask spread to create a market for you. Many market makers pay your broker rebates for routing order to them, payments for order flow, which we will discuss soon. Still, brokers must report the quality of executions on a stock-by-stock basis to ensure investors get the best execution. Point being, your broker has many destination options to route your order to besides actual exchanges, and they should automatically find the best option for you and give you a quality fill. As you compare firms, look at customer reviews and statistics about how often customer orders get price improvements. Consider which broker will give you the best fill possible. Any small amount of slippage can quickly add up over time, especially when you start placing large orders. Remember that order fill quality and payment for order flow generally only changes how your broker directs market orders, if they direct them away from exchanges at all. To disclose their order routing rebates, SEC Rule 606 forces brokers to publicly report certain routing and execution metrics in a standard 606 quarterly report. This report reveals exactly which exchanges the broker routes orders to and outlines their rebate compensation from liquidity-providing market makers. Specifically for limit orders, your broker will most likely route your order through an electronic communications network that automatically matches buy and sell orders at specific prices. These electronic order books cut out market makers and let buyers and sellers exchange directly. They work best with high market participation rates, providing seamless liquidity. Your Level 2 feed is made up of open ECN orders, market makers that buy and sell when no one else will, and wholesalers who execute orders for online brokers and retail brokers. Remember that open but unfilled trades can be canceled at any time and may serve as bait to slightly more move a market up or down by spoofing other investors with selling or buying pressure. Recent U.S. crackdowns on high-frequency traders have lowered spoofing risks as more stable securities. According to a 2016 study by Organization for Economic Cooperation and Development, 58% of trading occurs publicly on exchange order books. In the other 42% of trades, your order may be routed to an OTC market maker, a dark pool market maker, a hidden exchange market, an internalization algorithm, a PFOF-sponsored market maker, or an electronic communications network. By increasing marketplace liquidity, market makers help you no matter where your order actually executes by constantly buying and selling stocks and make a market for your trade. The market maker buys the bid and sells the ask in hopes of making a small profit while making a liquid market, as you should when possible by entering trades through limit orders. Dark pools were created to facilitate bulk trading outside of public exchanges to minimize a market reaction to large trades before they complete. Large investors can sell bulk lots of stock, say a 1 million share block, at a static price outside of the market order books and overview rather than individually selling many smaller lots. Because buying and selling pressure moves stock prices, a large buy or sell order in the public market could prove difficult as the market reacts to such large orders. So, dark pools allow order fulfillment initially unrecorded to the market with lower fees. These transactions are not immediately published on traditional public stock exchanges and pre-trade data. In other words, your order showing up in the level 2 quote box is completely unpublished. After a trade occurs in the dark, it can take up to 1 day for it to appear in the public order book. Unless you are trading millions of shares, your broker will handle your trade execution automatically, and dark pool fulfillment will only be automatically used to receive comparable price fills from exchange order books to lower transaction costs. Huge buy and sell orders from institutional traders can significantly affect public perception of a stock's price, hence the creation of dark pools to trade out of public sight. You can profit from dark pool transactions by watching for extremely large orders from hedge funds, mutual funds, etc. Many brokers such as Interactive Brokers, Lightspeed, and TradeStation route orders through dark pools to buyers and sellers to efficiently fulfill your trade at the best possible prices. However, actually viewing transactions that go through dark pools proves more difficult since they are designed with opaque markets in mind. FINRA has recently made large strides to increase marketplace transparency in dark pools by committing to publicly publish trading information from alternative trading systems, dark pools, and other off-exchange market makers regarding all Tier 1 national market system stocks on a 2-week delayed basis, terminology from Chapter 33. All other stocks and OTC trades are subject to standard trading report requirements and are released 2 weeks following the Tier 1 release. However, it is tough to make informed swing trades based on 2-week-old data. Currently, Charles Schwab and Lightspeed are the only 2 brokers out of the many we will discuss soon that let you directly monitor large dark pool trades via their desktop trading platforms. Charles Schwab uses the proprietary StreetSmart Edge software to deliver this market depth through the block trade indicator. Lightspeed also displays the block trade indicator through their Lightspeed trading desktop software. Simply open an account with one of these brokerages to access their software platform and data. As you configure your block trade indicator, set the window to show orders with a minimum block size of, say, 500,000 shares. This will show you orders from all exchanges exceeding 500,000 shares. You can further specify your search by only displaying orders from dark pool exchanges, common dark pool ticker ADFN, while removing other mainstream exchanges, the NYSE, ARCA, BATS, etc. If you want to spend more time analyzing dark pool orders for large buyers or sellers, you can add an additional indicator showing block trades over 50,000 shares. Remember that these indicators show all market trades by default, not just those for one stock. The indicator also displays the time the trade was released to the public and at what price it executed at. Large discrepancies between huge dark pool order prices and current market prices show that a trade happened far before it was actually reported on exchange books and transfer registrars. Note that the data does not tell you whether the institutional trader bought or sold the underlying security. By analyzing dark pool trade history and placing orders mimicking institutional traders with massive accounts, you can find decent profits in swing trade setups. If you do not want to commit to 9 to noon trading, then you may consider this trading style. Nonetheless, this methodology acts as a solid complement to your technical analysis and can undoubtedly help you make a few strong swing trades each year. This strategy with dark pool trading involves 3 simple steps. Identify an abnormally large, say 1 million plus shares on a $40 stock. Higher is better. Trade. Wait for the last hour or so of trading for the day the order is executed or appears to have executed. Determine if the stock will close above or below the massive dark pool order price point. If above, buy. If below, short. This strategy assumes that people with lots of money, presumably fund managers or perhaps corporate executives, know insider information or otherwise non-public secrets. Here's an example with Energy Select Sector Spider ETF using a 500,000 share block trade indicator. Notice that the fund is far out of the normal 9 to noon price range of 20 cents to $20. So we see here with XLE, yeah, that's the ticker. You have about 4.88 million shares traded at about a $55 price level on the ADFN dark pool exchange. This abnormally large trade early in the morning, after this abnormally large trade early in the morning, XLE continued to trend down until around noon, as shown below. The stock closed at 55.83. Since the stock closed above the dark pool order, the steps outlined above predict a future run-up. We predict that the large order was a buy order, and this buying pressure was well informed and will squeeze the market up. A stop loss on a dark pool trade should be slightly above short position or below long position, the massive order, since the price is an established psychological level by some large trader. Here's how XLE turned out after 2 weeks of trading. Then we see after that initial order entry, it had a huge uptrend for just about the rest of the given time period, especially after that initial close at 55.83. It was going, to about 62.50. So a strong gain above that entry point of 55.56 in the dark pool entry. Dark pool trading fits into your time-tested written trading style. You can access the aforementioned institution's platform and trading data while still trading with another brokerage by simply opening a small or empty account. You look more at minimum account standing and more with a specific broker soon. Every stock trade, no matter its execution destination, must be reported to a stock exchange to update the transfer agent and registrar so that the underlying transfer agent can update shareholder information. In the case of an off-exchange transaction, most reporting is sent to the stock's home registration and initial public offering exchange. In traditional exchanges, this usually occurs within 90 seconds of a transaction. However, book registration with transfer agents and registrars slightly differs when you purchase a stock through your broker. Rather than your name, address, etc. on a company's registrar, the stock, mostly for simplicity's sake, is held in your broker's street name. Similar to direct registration, you do not receive a physical stock certificate when you buy a stock through your broker, who subsequently uses street name registration to identify itself as the security manager on your behalf. Your broker then simply keeps its own records of who owns what stock, while the underlying companies send all mail, physical and digital, such as dividend payments and annual reports, to your broker, who subsequently distributes dividend and mailed information to you. As we talk about in Chapter 18, centralized clearinghouses act as a middleman for futures and commodities. These clearinghouses collect cash maintenance margin, and underlying assets between anonymous buyers and sellers and oversee the delivery of a contract at expiration date. Your broker connects you to these contract clearinghouses alongside options markets at essential exchanges. Lastly, your broker connects you to global decentralized over-the-counter currency exchanges. As you analyze potential brokers to deal with, consider their order fill quality. As we have seen, brokers may have many different options for routing orders. By getting the best fills possible, you will minimize any unforeseen losses when you enter and exit a position. With that said, it is particularly difficult to measure how well or poorly your broker fulfills your order since there is no common metric to identify order quality. All your broker can do is look for potential price improvements and either fill you or leave your order open if you submit a limit order. Nonetheless, consider what online reviews say about your broker, especially once you start making larger orders. A couple of cents off the bid-ask spread can add up over time just like any other fee. On top of fill quality, consider order speed. The faster your orders get to the market, the better chance you have of being filled at the price you see on your screen. With centralized investment markets, high-frequency traders in thinly traded stocks can place market-making orders in the order book across different exchanges. Fill a small portion of your market order at the first exchange your order electronically reaches, and then cancel the rest of their orders at other exchanges before your order physically arrives by using high-speed signals linked to the physical exchange data center, so that you unintentionally get worse fills when your order reaches the now higher-priced order book microseconds later. Use a limit order when possible to avoid this tactic. For 9 to noon trading, especially, consider what desktop trading platform a broker includes. Since you will stare at this all morning, it is important that the software works well for you and gives you all pertinent trading information. A poorly organized, sluggish, or otherwise unintuitive trading software can significantly hurt your trading efficiency and returns. Your broker should also give you live data feeds from all major exchanges. Check to see if you have to pay for a special live data fee for access to some markets, for example pink sheets, or perhaps a software usage fee. These platforms and data fees can be large recurring monthly charges at some brokers, while they are included in commissions for others. If you're only swing trading or making long-term investments, then an active desktop trading platform matters less since you can simply use Yahoo Finance alongside your brokerage. To link your brokerage to Yahoo Finance, simply open any portfolio and press Link Broker. From there, you can link any of the following brokerages: 2018, Fidelity, E-Trade, Coinbase, Robinhood, Just a Trade, AliInvest, Interactive Brokers, TradeStation, Tradier, Drive Wealth, Partnered Applications, TD Ameritrade, Charles Schwab, Vanguard, or Capital One, acquired by E-Trade. This linking process is completely free from Yahoo Finance. You simply pay your broker's commissions and fees. You can search for brokers with lower fees if you use the service, since you can worry less about your trading platform and newsfeed as a less active trader. With that said, you can still use high-quality desktop software to streamline your analysis. We will look at platforms soon. Lastly, consider trading fees when you compare brokers. Aside from trading software for active trading, commissions are arguably the most important brokerage factor. How much your brokerage charges you to trade directly affects how much cash you make for long-term and short-term trading. Most full-service brokers that offer you investment advice, education, etc., charge commissions on a per-trade basis. However, you do not need much help constructing your portfolio since you read this book and will practice trading while you get used to the markets and can forge your financial future. Therefore, you can avoid full-service brokers and opt for more budget-friendly brokers that connect you to all trading markets with minimal costs, yet strong account management and customer support. Many discount brokers offer both per-trade and per-share fee structures. So, rather than paying X much per trade, you can pay X much per shares traded, often with a minimal cost. For active traders, this cost structure almost always results in less commissions and higher profitability. For long-term investing and swing trading, consider your average order sizes. It might make much more sense to use a per trade commission structure if you make particularly large trades often or trade extremely cheap stocks. Do the math to find out which fee structure takes less money out of your pocket once you start trading, and determine your average position size based on average position value. Note that per share fee structures especially help for active trading when you want to slowly scale out of a position. For example, you could buy a stock at $7, watch a giant run up to $9, and sell half your position. Since you only sold half of your shares, you can hold the rest if the price keeps climbing, or sell the rest if momentum teeters off. You can also use a ratio for this example, buying and selling different amounts of stock as you slowly phase in or out of a position. How much you do this depends greatly on your personal trading strategy and risk management mentality. Do you want to lock in maximum profits all at once, or wait to see what the market will do while you take some profits off the table? Perhaps you want to sell half of your position once it doubles to get your initial investment back. Your trading experience will help you develop this mindset. A profit-taking stop or market if touched order can automatically help you take profits, but it can also cut off future growth. Try to stay decisive, disciplined, and research for maximum profitability. Either way, you often pay much less for your single or multi-part trades on a cost per share basis because, for example, you pay the full commission to buy 100 shares, pay around half to sell 50, and then pay the last half to sell the rest. Compared to an X dollar trade plus an X dollar trade, this per share structure can bring your commission down to a fraction of comparable fees. Here's a comprehensive table that compares a long list of major U.S. brokerages ranked from highest to lowest commissions. This list looks only at equity trade costs. Assume that options contracts and other asset classes follow similar pricing trends for each broker. Each broker is assumed to trade stocks, options, mutual funds, ETFs, foreign currency exchanges, futures contracts, and bonds. Many of the brokers below offer commission-free ETFs. The nature of these offers, alongside the quality of the underlying funds, changes frequently. Though it is hard to judge order execution, a recent well-developed study found that Fidelity, Interactive Brokers, Charles Schwab, TradeStation, and Merrill Edge were ranked the top 5 brokerages by order execution quality, best to worst. U.S. brokers, 2018. All of these are going to go through, we're going to go from name, the trading platforms offered, per trade fee, and the per share fee, and a minimum balance to start your account. There are some notes for each of these brokerages. So for the first one, which is T. Rowe Price, we see that $9.95 trades if you make over 30 trades per year, or have $250,000 in your account, or $2,800 commission for mutual funds, $35 commissions for other mutual funds, a $30 annual fee, which is waivable. A lot of the brokers we're going to look at have slight caveats or excess notes like that, which are great. If you're interested in each of these brokers, 100%, go ahead, check out the data, check out the fine print for each of them. Those will help you, especially if you want to identify very specific benefits of individual brokers that you're looking at. But for general overview, I'm just going to go through the names, the platforms, and the pricing, as those are pretty much your most important factors. So we have T. Rowe Price. They have online and mobile platforms, and they charge $19.95 for a trade. USAA has limited website and mobile platforms. They charge $8.95 per trade. Vanguard charges an online platform. They charge $7 for the first 25 trades and $20 after. Merrill Edge is an online platform and Merrill Edge Market Pro platforms, and those charge about $6.95 per trade. Then there's TD Ameritrade, which has its web, mobile, and Thinkorswim platforms. And those are $6.95 per trade. Then E-Trade has the Power E-Trade, E-Trade Desktop, and mobile platforms, which charge about $6.95 per trade or $4.95 with 30 or more trades per quarter. Wells Fargo Wells Trade has online and mobile platforms. That's about $5.95 per trade. And all of these have either account minimums to start, or some of them are zero. Charles Schwab's $0 startup. That's got web, mobile, and street smart edge platforms that are about $4.95 per trade. Ali Invest has Ali Invest Live desktop platform and mobile platforms. That's about $4.95, which is lowerable to $3.95 with 30 or more quarterly trades or $100,000 daily balance per trade. Fidelity has Active Trader Pro, Stock Screener, website, and mobile platforms, and that's about $4.95 per trade. TradeStation has desktop, mobile, online, and dedicated scanner platforms for about $5 per trade. You must place at least 5 trades per year to maintain an account balance. There's an annual charge. A lot of fine print there. Sogo Trade has Sogo Trade desktop, Sogo Elite options, online, and mobile platform. There's about a $4.88 base rate and $2.88 if you execute at least 50 trades a month. Then there's Tradier, which has a base rate of $3.49 per trade, and they have an extensive list of supported platforms. eOption has eOption Trader desktop, website platform, options, and mobile platforms at $3 a trade. Tastyworks has Tastyworks desktop, mobile, and browser platforms for $5 opening order and $0 closing order, so an effective, one in, one out, $2.50 charge. And then Place Trade Financial has Place Trade workstation, website, and mobile platforms with no per share trading structure, or no per trade, but a 1 penny per share with a minimum of $1.50 pricing structure with a maximum 1% of trade value. Lightspeed has Lightspeed Trader, Sterling Trader, Live Vol X, Realtic Pro, online and mobile platforms, and it's about a $4.50 per share fee with an additional $3.003 per share fee for all pre and post market orders, and as a per share trading structure, it's $0.0045 or a default with a minimum of $1, and then $0.0065 if you use Live Vol X with a minimum of $1. And then a lot of the per share structures you'll see will decrease in cost as you increase in traded volume over time. Cobra Trading has Cobra Trader Pro, Dash Trader Pro, Sterling Trader Pro, and mobile platforms with a per share trading structure of $0.004 with a minimum of $1 per trade. It's got one of the most notably high account maximums like Centerpoint Securities, which has Centerpoint Trader, Sterling Trader Pro, and Dash Trader Pro platforms with a $5.95 plus minimal routing and regulatory fee per trade fee, or $0.004 with a minimum of 95 cents per share fee. With the per share fees, you just multiply the number of shares you trade by the per share fee. So for Interactive Brokers, which has the flagship desktop, TWS, mobile, online, and messenger platforms, you would be charged $0.0035 per share traded with a minimum trade amount of 35 cents and a maximum of 1% of the trade value. Just a Trade has Just a Trade desktop, Sterling Trader Pro, Aetna Trading Platform, their website, and mobile platforms. They charge $2.50 per trade, $12.50 for mutual funds, $75 for foreign stock fees, and for all orders add routing and regulatory fees. Definitely watch out for foreign stock fees, especially if you're going to be trading or swing trading international stocks. Sometimes you can trade American-based securities that are based on the same security or stock or company, but you definitely don't want to get slammed for a $75 foreign stock fee. And then they also have a per share trading structure that starts at $0.0025 per share with a minimum amount of 50 cents. Choice Trade has the Quote Stream Trader Pro platform, Direct Pro Trader, Choice Trader Elite Trader website, and mobile platforms with a $0 trading fee and a $5 monthly fee, or $5 per trade. Trades on stocks under $1 are $5 regardless of your monthly fee, and OTC trades are $7 plus routing fees. Folio has their website platform and basic screener platforms, and there's $0 for your first 2,000 orders if you subscribe, or $4 in trading windows otherwise. And the subscription is $29 per month or $290 per year if you pay in bulk. And as a little bit of a more interesting note, orders only execute around 11 a.m. and 2 p.m. EST at market each day, so you're not going to really have great control over your price executions. And they do sell fractional shares, which is cool. Betterment is a website and mobile platform. You do not actually make direct trades. You have a digital advisor, and those advisors put you in portfolios with % annual investment fees for digital investments or premium investments, depending on who you want managing your money. And then there's also annual fees. So those are just charged as a percentage of your portfolio. You don't really trade individual stocks. Then there's UStockTrade, which has web and mobile minimalist platforms for $1 per trade plus $1 monthly fee. Then Stockpile has web and mobile minimalist platforms. They charge 99 cents per trade. You can also buy stock gift cards, which is cool, which just costs additional fees. Acorns has a mobile platform, and they have $0 per trade fees with a $1 monthly fee, $2 if you want an IRA, $3 if you want a checking account, and you can only invest in Acorns pre-built and unchangeable portfolios, so no individual stocks. M1 Finance is an online and mobile platform. You get $0 per trade plus minimal routing and regulatory fees, and you can use fractional shares, but with this one you're really creating custom weighted long-term portfolios. So those long-term portfolios aren't going to have intraday trades or specific orders, but good for long-term portfolio management. First Trade has First Trade Navigator, Options Wizard, website, and mobile platforms. And First Trade is $0 per trade plus minimal routing and regulatory fees, or $0 per share. That fee includes mutual funds and options. Also, no account minimum, which is nice. Free options trading, the only thing to note is a $14.95 execution charge. And then they've got commission for ETFs, no IRA fees, which is great. A lot of these do have IRA fees, which kind of stinks. And no check or electronic transfer fees. No data fees. Definitely some of them will charge you data fees for active trading, so you don't want that. And they're kind of cool. First Trade has a 0.1 second trade execution time guarantee. And then lastly, Robinhood is an online and mobile minimalist platform. $0 per trade with free options trading and execution. Only note is that it's the only broker out of all listed to not offer dividend reinvestments in 2018. And also, it's the only broker that does not allow you to short stocks. However, you can buy puts, so you can make it work with options, just a little bit riskier. They also allow you to directly trade cryptocurrencies, which is pretty sweet. If multiple tiers of commission plans are available, the most basic, lowest volume tier was used. If you have significant trading volume, explore tiered per share rates from the lowest cost per share brokers to find the best deal for you. Other conditions may apply. See current broker website for details or promotions. Many large firms constantly offer free trades for signing up, so you could get away with using a bigger broker during a trial period and then moving to another, more affordable one after the promotion ends. This also gives you many chances to try out different charting software while you make free trades. Just remember, like with all these brokers, as long as you get the same price fill, you're still buying the same stock from everybody. I highly recommend TD Ameritrade's Thinkorswim platform for charting. You can open up an account and leave it sparsely funded to get access to the platform and live data feeds. If you're a long-term investor or swing trader, then you can use this platform for analysis alongside Yahoo Finance while executing your trades and holding your positions in a much cheaper broker like Robinhood or perhaps M1 Finance if you want to spend less time managing your investments. However, if you trade 9 to noon, you will want a broker with both a strong platform and strong commission structure. Remember that you can create separate accounts to isolate your active trading and long-term investing. With a dedicated active broker, you can enter and exit positions faster as you will directly see them set up. Interactive brokers and Lightspeed work especially well with their desktop platform and low fees. Explore the many platforms above, ranging from Dash Trader to the unmentioned Ninja Trader. You can link external software with your broker, but it's much easier to use the provided desktop software to ensure extremely fast order execution and live quotes, especially when many trades end in 15 minutes or less. Visual appeal with these platforms is crucial, as you will stare at them every morning. Find a platform that flows well with your trading to increase your productivity while also operating with low fees. Not to mention, high-quality trading platforms help you quickly scan through more and more potential setups. If you're only investing for the long run, consider how much time you want to commit to your financial future. Some of the brokers above help you manage your money for a small fee. Others simply give you access to globally leading index tracking ETFs for very low prices, notably Fidelity with its zero commission and zero expense ratio funds. Otherwise, you can stick to the free Yahoo Finance analysis tools and screeners we have explored to maximize your potential returns with individual trades. If you want to start trading actively but are still stuck under the PDT rule, then you can get away with cheaper charting software, since you only have to make a few really good trades per week, and most live data feeds will let you do this with a fairly fast order entry box. However, try to practice investing, especially as you first begin, as if you have an account 10 times larger than your current portfolio. With this mentality, 10% gains will, as they should, seem phenomenal with long-term investments, and you will prepare yourself to manage your future money when you do grow your account. By taking your trading especially seriously, you will learn to master level 2 quotes and live data through your broker's initially complex desktop platform, a platform that will serve as your gateway for future profits. Many of the brokers offer after-hours trading. Like we said earlier, try to stick to market hours trading to maximize volume and minimize spreads. However, this feature can prove handy if you want to make a quick trade based on news such as an earnings report. You can never be certain where a stock will open the next day after the market closes. For this reason, try not to buy stocks at market open with limit orders generated the night before, as you may significantly overpay for a stock that quickly tumbles the next day. Generally, early morning trading in all stocks set securities up for red or green, up, down or up trading days, as most stocks collectively follow major market indices each day. Lastly, some of the brokers above advertise their tax efficiency or easy year-end accounting. Losses do cancel out gains with respect to their trading timeframes. However, I implore you to worry less about taxes and more about making as much money as you possibly can. At the end of the year, you can offset gains by selling losing stocks, but you can also cut off future growth by closing out temporarily down positions that may outperform in the long run. I gave this warning from experience. In the earlier technical example with AMD, I bought the stock as a fundamental play since I saw the company growing. So I shared the position with investment friends. One friend took a position at $13 as AMD bounced around in a downward wedge. At the end of the same year, this friend chose to sell their position at a loss of $11 to offset short-term gains, particularly because they knew little about the underlying business fundamentals. Was the tax benefit worth the loss? Just a few short months later, the stock popped out of a downward wedge to a long-term resistance over $33, where I sold half of my shares. Make trades normally, and your broker will send you the necessary 1099s to pay the right amount of taxes. Nonetheless, still remember tax laws. I sold my shares on the exact day I bought them the year before, forcing the sale into short-term capital gains tax bracket. I could have eradicated my capital gains taxes by waiting just one more day to exit the stock. Learn from your mistakes to strengthen your trading.